today, and I wanted to get your thoughts on gold stickiness around 1700, especially after we saw Friday's job number come in. The U.S. economy creating 2.5 million jobs last month. Maybe not the best jobs in the world, low paying, but I'm sort of wondering. What are your thoughts on gold in what looks like maybe a V-shaped recovery?
Yeah, quite a surprise on Friday, and I think it's one of those situations where a big miss, right? And I think that was probably the biggest part that came out of the conversation was how did we get it that wrong, right? And so I think there will continue to be some outcomes of maybe the numbers aren't exactly that, and maybe we'll
Hmm.
see some type of revision, but nonetheless. Certainly a big number that came out on Friday, and you certainly saw that displayed in the market, not only equity side, but also the gold side. And so it has started to bring back that conversation about what does the shape of this recovery going to look like? Is it, as you suggested, a little bit more V-like, or as we refer to it at Aberdeen, a little bit more U-shaped, or does it have some type of other shape? But certainly, from every indication, at least at this point in time on the equity side, it's certainly starting to look V-like.
Hmm.
From that standpoint, I guess the question is, how strong is the foundation associated with it? And can it withstand a little bit of a push or a little bit of negative news that may potentially hit at some point in time? So I guess the question is, how strong is that market? But it certainly looks like a V-like recovery.
So what do you think? What's gold's role then? Do we need a safe haven asset in this environment?
Well, I think, and we've talked about this in the past, Niels. I think investors can have continued to rely on something like gold throughout this period of time, just because there's still a ton of uncertainty that exists in the marketplace. And so, as we continue to see, as COVID-19 continues to take its own path, still to be determined, it's a good sign to see places like New York and Philadelphia and other major cities starting to relax a little bit and open up and come back to life. And certainly the markets are responding to that. And the markets are trying to forward look a little bit. But there are still concerns in the marketplace that still exist, right? Is there potentially a repeat that happens in the fall? Still to be determined. So that leaves the market a little bit of, still some doubt. We still have, there's been a heavy emphasis that's really placed upon sort of the consumer as part of this recovery. And clearly the consumer has been wounded by this process. And so it's a matter of, how quickly can they come at, and do we continue to rely upon these consumer-led recoveries? And so from that standpoint, as we've talked about in the past, interest rates at zero are certainly helpful from a consumer standpoint. But if the consumer is not willing to purchase, you could have rates at whatever. It doesn't really matter. And I think you're starting to see some of that indication where the consumer is holding back. I think there's some initial exuberance associated once markets opens, but you are starting to get the sense that the consumer is holding back a little bit with the expectation that perhaps there is a challenge that comes up, whether that's the fall or later from that standpoint. But as a firm, we expected a little bit more of a J curve type of recovery, sort of a prolonged challenge with a slow sort of recovery. But from that standpoint, that certainly is being challenged by the way that the equity markets have performed.
Just really quickly, you talk about, consumers not really reacting to low interest rates. We're actually seeing interest rates tick up a little bit higher.
Yep.
Do you think this is a trend that lasts? We're heading into FOMC meeting later this week. Do you think, what's your thoughts on the Fed trying to control the curve, and what does that do for the gold market and precious metals?
Yeah, I think you've been covering the gold market for a long time, and one of the biggest sort of knocks against the gold market or gold specifically, that it's a non-yielding asset. And so from that standpoint, having low rates tends to be pretty beneficial from a gold perspective. My take is that we are going to be in this period of sort of low for long for a pretty significant amount of time. The Fed has sort of indicated that so much that they're willing to intervene at any point in time. Does this potentially cause a little bit of a pause? Perhaps. But I think the reality is there are still elements that exist out there. You're going to have a period of low rates for quite some time. That's going to be supportive that is going to continue to be supportive for gold itself. And then I think you'll get some of these other factors. I mean, the thing that drove gold's performance in 2019 was everything related to trade in China, and we haven't even talked about those types of things. So we've seen some flare-ups. Some of the geopolitical stuff has been fairly quiet, to be quite honest. But I think that aspect, there's still elements out there, and I would absolutely expect this sort of low rates for a long period of time. My expectation is that we would continue to see that.
What are your expectations, sort of in the short term and long term, to sort of put your feet to the fire? I mean, do you think we see gold struggle through the summer? What's your year-end target, and has that been impacted by what we're seeing in the economy?
Yeah, I mean, I think we'll see gold rate pretty range bound. I think there's pretty strong resistance that exists in that sort of 1670, 1675 range. We also know that there's pretty strong resistance at sort of that 1760 range as well. My expectation is that we'll be fairly trading range bound for at least through the summer without any new information or no new insight or anything along those lines. That is sort of my expectation, at least at this stage. Our expectations a little bit, if we stretch out a little bit longer, our base case we held at the low end was $1,700 for year end. We're pretty comfortable with sort of where gold is trading at this point in time without any new insight, new information, anything along those lines. So I think, like I said, I think that 1670 to 1760 type of range, I think we'll see this tug of war that's going back and forth of new information, good and bad. And we'll see sort of that aspect, continue to play out through, my expectation is through the summer.
I was reading one of your reports or one of your comments, and you said 10% in a traditional 60-40 portfolio, 10% is a good allocation for gold. And I'm sort of wondering, I wanted to get your thoughts sort of behind that. Everybody sort of says, that between 5 and 10% is good. So I'm sort of wondering, do you think it's better to be sort of on the higher end, overweight precious metals in this environment?
Yeah, it's a great question. I mean, I think every portfolio is different in the way that it should be constructed, and whether it's 0% or 10%. Our typical suggestion is an allocation to gold should never be zero. Right. And one of the biggest questions that I've been asked over the last 6 months related to gold, and then even more so post sort of COVID-19 is, tell me a little bit about gold. And my response to investors and reporters and folks alike is gold did it exactly as you would have expected during the market turndown, right? It showed its true colors. It showed its ability to protect a portfolio against downside, any types of surprises and things along those lines. And so from that standpoint, we continue to say that, the optimal allocation to gold is never zero, right? It plays a role in a portfolio, and whether it's 1% or 10%, then obviously you can make some judgments. But I think what we're starting to see is in these environments where interest rates continue to be low, and folks looking for a diversification impact into their portfolio, fixed income isn't playing that role as significantly as it once was. And so what we're seeing is assets coming off of the fixed income into more alternative type of strategies. And gold does a really good thing in portfolios as it relates to alternative type of strategies. And so from that standpoint, gold has stood up. It has performed as expected in the portfolio. Will we see it, perhaps challenged as the market opens up? Yeah, absolutely. And we may see some allocations peel off of it. But the investment demand for gold continues to be high. And that has continued to sort of carry and provide that price support that we're currently seeing. But from that standpoint, my expectation is, those allocations, we may see some changes in those allocations. We might see some peeling off as risk starts to come back onto play. But its role in the portfolio is consistent and continues to provide those values that folks are looking for.
And just before we go, what are your thoughts on the other precious metals? I mean, what do you think of silver in this environment? I mean, if we are starting to see recovery in the global economy, is silver a good value play as industrial demand picks up?
Well, it's not quite as quite as much of a value as it is today as it was perhaps a month ago. But from that standpoint, as you had indicated, there's a pretty high correlation between gold and silver historically. And silver got hit pretty good when the market sold off. And that's typically the case. Silver does have a much more industrial component associated with it. And so therefore it tends to react a little bit more to what's taking place in the sort of the overall economic picture, economic market. But typically in the past, as we've seen, is silver also does a pretty good job of catching up to gold. And you have seen that over the last month or so. And so where silver for the last month was up 16+%. And so from that standpoint, there has been a catch up that's taking place. There's folks out there that are technicians, plenty of folks that spend time, a whole lot of time listening to other commentary that you provide, Niels. Is a lot of people do follow things like the gold silver ratio, and the gold silver ratio is a pretty good indication of value associated with whether it's on the gold side or the silver side. And so from that standpoint, we got stretched in that gold silver ratio to pretty historic portions. It's come back at this point in time, but it would still certainly suggest that there is value associated with silver. And silver will benefit as the market tends to open up. You get some industrial components associated with it. And so from that perspective, silver will benefit not only from that correlation to gold, but also from the industrial component associated with it. So we've seen a lot of demand, specifically from a silver perspective. That investment demand continues to pick up. And so from that standpoint, my expectation is, yes, there's still value there, but not as much value as there was perhaps a month ago.
That's perfect, Stephen. I thank you very much for your time.
Sure. No, thank you.
I've really enjoyed this conversation. And the thing I learned is the only bad gold position is no position. So thank you very much.
Yeah.